So what if I told you that there really was a legal way for you to buy a $500,000 rental property and then save $56,000 in taxes your very first year buying it, to then use those tax savings as a down payment to buy another property? Obviously, you know me, I don't do get rich quick schemes, okay? This is legitimate. It's a tax strategy that just became permanent. And that's why I want to share this with you, because it hasn't always been permanent, but it is permanent. And I want to really kind of just break down some of the how-tos on how to really use this to accelerate your own real estate portfolio. And really what we're talking about is creating a snowball effect where your tax savings become your next investment capital to be able to be used for your next house. So here's the 4-step game. Step 1 is buy an investment property using the new 100% bonus depreciation. Step 2, generate massive tax savings in year 1. Step 3, use tax savings as your cash to buy your next property. Step 4, well, repeat the process. Repeat the process to be able to buy your second home, and then your third, and build a portfolio even faster. And I think what is cool is that this strategy, honestly, it just became permanent under the Trump administration, his new tax law, right? And this is what smart investors have been doing in the past, but as there hasn't been as much opportunity as there is now, and they're positioning themselves. Smart investors right now are positioning themselves to be able to take advantage of this new tax strategy. This is what most people don't understand. It's not just about tax savings. This is really about turning those tax savings into investment fuel. And before this change, bonus depreciation was actually being phased out. You could only deduct 40% immediately the very first year, and now it's back to 100%. And so when you combine that tax savings with something called cost segregation, this is where you just can create what people like to say is a cash generating machine. So let me show you exactly what a formula looks like with some real numbers. All right, so let's just talk about your very first rental property you're going to buy. This is your foundation. Property 1, you buy this for $500,000 as a rental property. And then you do a cost segregation study, which identifies about $175,000 in maybe components, right, in the home that would qualify for immediate write-offs on that house. Now, if you find yourself in a 32% tax bracket, that would then be $56,000 back in your pocket in year 1. Plus, of course, just the normal cash flow that you would just get from the rental property. You take the $56,000, and now we have property 2. And this is where you use your tax savings, right? So you use that $56,000 tax savings as a deposit to buy home 2. That would put you buying maybe a home around $280,000 as a rental property. And then you simply run the same tax strategy again, where you do cost segregation. That would put you at about a $32,000 savings because that house is a little bit less. And then you simply grow. So you went from 1 to 2, and then you can go from 2 to 3 a lot quicker than if you were to simply wait and save up a full 20% down payment for every single house. So now you're kind of getting the gist and seeing how owners of properties can quickly go from owning 5 to 10 to 15 in just a few years, really using the government their own tax saving incentives as fuel for your own investment growth. So now let me explain really how this actually works, because understanding the mechanics I think is kind of important. So just this big question, what is cost segregation real fast? Cost segregation is kind of like having a forensic accountant dissect your entire building or your home or your commercial building. They dissect it and they figure out what items can actually be depreciated over, if it's residential, it's 27 and a half years, or if it's commercial, it can be up to 39 years. And so they identify these components that can depreciate much faster. So things like kitchen appliances and fixtures, they can usually depreciate those at 5 years. Carpeting, window treatments, 7 years. Driveways and landscaping, they can usually depreciate that 15 years. And I think there's like specialty electrical and plumbing systems. Again, this is why you have an engineer who actually works with a CPA. So that's what cost segregation is. It's putting that study together. And then you have 100% bonus depreciation now, right? So what that means is every dollar that can be figured up in cost segregation, right, of what they could actually deduct immediately. So not deduct over 5 years, 7 years, and 15 years, but actually they can deduct all of that right now, like 100% of it right now. And that's why a lot of investors really want to use this, because they don't have to wait that 27 and a half years to kind of get a little trickle effect of their deductions. So I think the combination creates this beautiful tax deduction, wealth generating system to be able to buy real estate. So I don't know, it's kind of like getting a rebate, right, from the IRS for buying real estate. That's pretty awesome. So if you have like a high W-2 paying job where you're paying a lot of taxes, if business income that you want to actually get savings on those taxes you're paying, if you are a real estate professional, a lot even more deductions, but you will absolutely benefit from this 100% depreciation. So if you are serious, y'all, about building just real estate portfolio, by far learn more about this, okay? I'm not a CPA, I'm a real estate agent. I'm not a cost segregation engineer. I'm an investor, okay? But I wanna help you know about this so that you can talk to the right people. So what I'd love to do is, if you want, I can put you in touch with a great CPA. If you don't have one yourself, I can put you in touch with a cost segregation company. And then you could go learn, one, from your CPA if they think that this could benefit your upcoming kind of tax year, and two, talk to the cost segregation just to make sure you understand the nuts and bolts directly from them. And then three, buy me coffee so that I can sit down with you and we can put together a great strategy to go buy that house that maximizes your tax savings and gets you the cash flow that you want. So hope you found this valuable. I'm excited about this. So start buying houses this year, because again, it started after January 19th.